Fed looks set to lower borrowing costs later today. But what will the easing path look like in 2025? Welcome to Market Insight. I'm Ramzan Karamali. Well, it's being called a hawkish cut. The US central bank is widely expected to cut interest rates by 25 basis points later today. But how much lower will interest rates go next year looks increasingly uncertain. So what should investors be looking out for when the Federal Reserve also reveals its outlooks and economic forecasts? Well, to help answer that and more, I'm joined by Russ Mould, Investment Director at AJ Bell. Russ, thanks so much for joining us. Well, all eyes will be on the Fed later today. Do you expect a hawkish cut too?
I'm not going to argue with the CME Fed Watch when it's predicting a 95% chance of a cut today to 4.5%. So I certainly won't go against that flow. But as you say, what's much more interesting is what they say for the future 12 months. Had we been talking 4, 6, 8 weeks ago, would have probably been talking about the rate going down by a full percentage point next year. 4 cuts down to 3.5%. Now, markets seem to be looking at 4%, a much more measured rate of decline, maybe just 2 cuts next year.
Well, just over a week after Trump takes office next month, the Fed meets again. So does that completely rule out a rate cut in January?
I wouldn't say so. I mean, the Fed is famously, quote, data dependent. It's trying to manage its dual mandate of 2% target of inflation on one hand, maximise employment on the other, but also in the back of Jay Powell's mind, whether he publicly denies it or not, will be the federal deficit, that annualised interest bill of $1 trillion a year that's bearing down on American economic growth. And it would be helpful for the US and certainly President Trump, elect Trump, if they can get that interest bill down by cutting interest rates.
So does that mean the battle against inflation in the US is won?
Well, at the moment, it's still running a little bit ahead of that 2% target. And I wouldn't want to be doing a victory lap, given that wage growth is relatively resilient and services inflation is proving particularly sticky, looking at the Atlanta Fed survey of that, for example. So, no, I don't think we can do a victory lap. And then what we're waiting to see, of course, is what President-elect Trump does in terms of tariffs and what impact that has. There is an assumption they're seen as inflationary because they naturally make things more expensive at first. But over time, the best cure for high prices is high prices, and they tend to destroy demand or stoke supply. And going back to the 30s, the 1930s, lots of economists will tell you that tariffs actually made an economic situation worse and contributed to a depression through killing off trade flows. So we will wait to find out.
Now, US interest rates aren't the only ones in focus this week. On Thursday, the Bank of England has a decision to make. Do you think policymakers will factor in November's 2.6% inflation reading into tomorrow's decision at all?
I've seen lots of comments suggesting that they will, particularly coupled with the wage growth figure that we saw. But frankly, I hope not. If it takes monetary policy 18 to 24 months to have an effect, really the Bank of England is trying to set the cost of money for 1 to 2 years hence. And doing that by looking at backward-looking data does raise the risk of policy error.
Now, going forward in 2025, what do you expect the easing path to look like for the Bank of England?
Again, similar story. I think the markets have begun to price out interest rate cuts. So Governor Bailey is publicly saying he still thinks there could be 4 rate cuts next year, down to 3.75%. The financial markets aren't so confident in that now. They're looking at around 4%, so maybe a 2 or 3 cuts at the very most. Again, with sticky inflation, a key reason for that. And the 2-year gilt yield doesn't agree either. That's actually not too dissimilar from where we are now. So that's almost, if not pricing in slower cuts in 2025, it's almost pricing in rate hikes for 2026.
Now, Russ, we're coming towards the end of 2024, and I think it's time to get your crystal ball out. The FTSE 100 year to date is up around 6%. What about 2025?
Well, current forecasts have around roughly 12 to 14% earnings growth next year, 6 or 7% dividend growth. So if you say 9,000 as a nice round, easy to remember number, that still means that the market overall would derate slightly on a price earnings basis, keep around a similar dividend yield of just under 4%. Throw in some merger and acquisitions and buybacks on top. That doesn't seem like science fiction unless we get a major economic dislocation of some kind.
Russ Mould from AJ Bell, many thanks for your thoughts. And that's Market Insight. Don't forget, you can watch more videos on Reuters.com.